US stocks are soft ahead of Chair Powell's Jackson Hole speech tonight. New Zealand's trade bounce may be at a turning point, and there's price pressure showing through in Japan's manufacturing sector. That's coming up in 5 Things in 5 Minutes on Friday, August the 22nd. And in our deep dive interview, ANZ Economist Aaron Luk has been looking at how Australian consumers react to Reserve Bank of Australia rate cuts.
We examined different indicators across different easing cycles, and what we found was that it's actually not that unusual for consumers to be a bit slow at first.
But first, in 5 and 5 with ANZ, all eyes are on Fed Chair Jerome Powell's final Jackson Hole speech tonight, with the Conference of Central Bankers focused on the themes of labour markets in transition, demographics and productivity. ANZ economist Bansi Madhavani is watching for two things. Firstly, whether Chair Powell will signal a resumption of Fed rate cuts next month.
Our assessment is that the labour market has weakened materially beneath the surface. The unemployment rate is holding up steady, but that's largely because participation rate in the economy has fallen, and we don't expect that trend to continue. So it is very likely that unemployment rate goes up once participation picks up. So on those bases and also on early signals that inflation is likely to be transitory, the one that's back on the tariffs, we're expecting that the Fed will begin cutting rates in September. Chair Powell, however, is not likely to commit to a timeline, as the Fed would like to see more data before they resume cutting rates.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was down 0.4%, the Nasdaq down 0.5%, the 10-year US Treasury yield up 3 basis points at 4.33%. Gold down 0.2% at $3,382 an ounce. West Texas oil futures were up 1.3% at $63.53 US a barrel after news that peace talks between Russia and the US have stalled. The US dollar index was up 0.4%. The Aussie dollar, though, flat at 64.26 US cents, and the Kiwi also flat at 58.20 US cents. Number 2. Secondly, Bansi is looking for the results of the Fed's once-in-every-5 years review of its monetary policy.
It is a possibility that the Fed moves away from flexible average inflation targeting to a fixed 2% inflation target. In the short term, we are not thinking that this shift will change our near-term view of the monetary policy, given that policy is pretty much adopted with a forward-looking lens and of rate setting.
Number 3. New Zealand's goods trade balance switched back to a monthly deficit in July after 5 surpluses in a row. ANZ senior economist Matt Galt says an improved annual deficit looks to be at a turning point after a solid run.
The goods trade deficit certainly improved a long way from where it was a year or two ago when the trade deficit was being driven by an overheated economy. What we've seen in the last few months is that exports have come off their recent peak, reflecting a combination of lower prices and lower volumes, and imports have been steady, but we'd expect those to gradually increase as the economy recovers.
Number 4. Japan's Manufacturing Purchasing Managers Index remained in contraction in July, while services activity rose at a slower pace. ANZ FX analyst Felix Ryan says the key points were a large drop in export orders and price pressures, which keep showing through.
Little bit of a rebound there in some of the input prices on the services side of things. We are below the peak that we saw a few months ago on that front, but still when we look at the trajectory of that indicator, it is well above those historical levels. So it does suggest some ongoing pressure there, at least on the input side of things for service prices, and it does sort of track well with the trajectory of some of those core CPI indicators from the national and Tokyo CPI prints. So definitely some inflationary pressure still bubbling away on the background there.
Number 5. That data in Japan comes after second quarter growth was stronger than expected last week, with the yen gaining support, says ANZ Head of FX Research, Marjabeen Zaman.
Our view for year-end for dollar yen is at 138. Basically, this stronger GDP number really points to the view that the BOJ has really no barriers in front of them. They've got a high inflation. They've got growth that actually is looking okay. And the Tankan result survey also showed that businesses are willing to spend on capex going forward. So again, all of that points to a pretty decent outlook there, which should not get in the way of Japan raising rates. We expect the BOJ to raise rates in October.
Marjabeen Zaman there. Now, in today's deep dive interview, ANZ economist Aaron Luk has been looking at how Australian consumers have responded to the RBA's recent rate cuts and how that compared to last time around.
So just stepping back a little bit, I think early this year, there has been some concerns about the consumer sector. I think the RBA had cut interest rates in Feb, but consumers seemed a bit slow to respond. Now, at the same time, the RBA had actually been expecting a sustained pickup in consumer spending since late 2023, but it kept pushing it out. about. So there are some concerns about whether or not households are responding to the current easing cycle as they have done in the past. So look, what we did was we examined different indicators, things like retail sales, vehicle sales, consumer confidence, and house prices as well across different easing cycles. And what we found was that it's actually not that unusual for consumers to be a bit slow at first. Compared to history, consumer activity in the current easing cycle is actually not too different to what we have seen in the past.
And I guess just going back to that RBA view, they're also looking at this super strong labour market. So would that have been contributing to why they thought that consumer spending would be higher than it was?
Yep. So look, for the last couple of years, the labour market has been relatively strong, and that partly explains why we've been seeing that recovery in income and household finances as well. And that would obviously usually translate to a pickup in consumer spending, but we really haven't been seeing that for the last little bit. Look, consumer confidence has been quite weak in late 2024 and also early parts of 2025. That helps explain some of that weakness we've been seeing in consumer spending.
Why has that consumer confidence been relatively weak, particularly because we've had those stage 3 tax cuts, we've had cost of living support in Australia, both federal and state level. But I guess while consumer confidence got a little bump, it hasn't really been able to break above that sort of 80 to 90 level, eh?
Yep, that's right. So confidence did decline in March and April despite that rate cut we saw in February. And we do think that things like trade uncertainties and market volatility might have come into play as well. But look, those things have somewhat settled more recently. And we do think that consumers were a bit more upbeat recently because they were expecting a rate cut in July.
What do you think is needed for that consumer spending expectation that the RBA had? What is needed for that to really sort of embed itself? Or is the slightly weakening labour market now going to hold that back?
Look, yes, like I was talking about earlier, retail sales were a bit weak early in 2025. But if we just look into the May and June data, things are actually improving a little bit. So we've got end financial year sales boosting discretionary spending. We saw consumers making big ticket items on things like TVs and furniture. Look, we've only got about 4 months of retail data, and the retail data has actually got cancelled by the ABS. But look, so far it's performing relatively in line with what we saw during the 2011 easing cycle. We actually did see a very, very strong pickup in retail sales during the 2008 easing cycle, but I think that is like an exception. Just keep in mind of the fact that we saw a lot of fiscal support during the GFC, so we don't think we're going to see those levels of spending this time around.
And obviously another factor for households is house prices and housing lending. We're seeing a tick up in Australia's housing market now. Could that sort of help pull along consumer spending with it?
Look, usually there is a pretty strong wealth effect from increasing house prices. We do know that when house prices go up, consumers generally feel a bit better. They do think they have a bit more net wealth as well. So consumers do usually spend a bit more when house prices go up. And our current forecasts indicate that we expect house prices to go up by 5% in 2025 and 5.8% in 2026. And we do think that some of that will flow through into consumer spending as well.
Aaron Luk there talking to my colleague Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, August the 22nd. Catch you next week with an analysis of Fed Chair Jay Powell's final Jackson Hole speech and what it could mean for global interest rates. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.